Hey everyone, my name's Andy. My channel is Finding Value. If you're new to the channel, welcome. If you haven't subscribed, please subscribe and click the thumbs up button if you enjoy this content. Today we're going to go over the power to hold. And I know this is important. One of the comments, asked how what mindset do you have to be, or how do you hold these things? And I'm gonna step by step kind of guide you how you do it. So we'll go in here. I call it the power to hold, and it does take some experience. So how do you hold? If you don't know anything about value or the company, I'm willing to bet you're not going to be able to hold on to the company. You're not going to be able to go through ups and downs, through market cycles and all that. Almost every new investor goes through this period. I went through it. Everyone goes through it, and if you're not educated on the company, or you don't know if it's a good value, you're not going to get the full valuation because you just don't know what you're doing, and that is completely normal when you first start investing. You will most likely be chasing stock prices, and you won't be strategically placing bets in undervalued propositions. That's just what happens when you're new. You'll probably be stressed out and not knowing what to buy, and eventually the losses start to rack up. That's kind of the normal process when you're brand new. So my suggestion is, know the value and market conditions. This is going to give you much more clarity in your investing. So I value commodities through ratios, and I'll give you a couple of examples of how I do this later on in the presentation. I see if commodities are cheap relative to other assets. Buy when prices are below the high-cost producers. That's when I buy. When you do this and you understand that money just flows from overvalued sectors to undervalued sectors basically repeatedly over time, that right there, knowing that, will give you the confidence to really hold on to your picks when you know they're undervalued. The next step is I ensure the market conditions exist and are ripe for a commodities boom. So that's our timing. So something can be cheap, but it can be cheap for a very long time. Our timing is when the market conditions are ripe. It's when those market conditions are changing. And I can show you what that looks like in the next couple of slides, what I'm looking at. I then look at the charts from a technical standpoint. Are they breaking down trends? Are they starting to move higher? That also gives you better confidence in your timing and better ability to hold on, because then you know what to look for in a bear market versus a bull market. And I think knowing all of these things above gives you the entire picture and will give you the confidence in valuations, timing, and picks, and the ability to hold on to your investments. And what I do is I continue to hold if the conditions are not changing. I don't sell out. I don't get scared out of my position because I look at the market conditions and I say, yep, it's still ripe. Yep, the valuations are still cheap. And I just hold on. I just keep accumulating if they're very cheap. So what I do after I take positions in companies, I validate and I monitor market conditions. So are prices increasing in the commodities that the companies I hold? Are they going up? Are the ratios compressing against gold and the S&P 500 over time? And obviously this isn't going to be a quick thing. It takes time, and they're going to expand and contract over time. But really the real big driver here that I've noticed and correlated, and I don't think a lot of people have done this, is are home prices increasing, which leads to housing starts increasing. This is also another market condition. So you need to look at inventory, days on the market, home prices, foreclosures, interest rates, etc. And is gold increasing? Because typically gold increases when home prices increases. And that's basically saying you're in an inflationary environment, because that's how that money gets in the hands of people, is through home prices and increasing real estate prices. So I'm going to go through some charts now and show you what I'm talking about. So what I'm showing you is the S&P commodity to S&P 500 ratio. And I have on the bottom here, there's green circles. These green circles means that they are low points in the ratio. And the red circles up top means that they're high points, which means that commodities are cheap in relationship to the S&P 500 in these green circles. It means that you want to buy commodities down here. And at the top, it means that you want to buy the S&P 500 and sell your commodities. And the black line is that period that you want to hold from buy to sell. That's what we want to do. And we're flashing a green indication of buying commodities right now. And obviously we're not going to have a red until it works its way higher. Commodities are going to outperform, this index is going to outperform the S&P 500 because money is going to rotate out of this and into this, and eventually these will reverse in valuation against each other. Another alignment that I've found is the housing starts. This is the new privately owned housing starts. So housing starts means that they're building new homes for people. The red line is the yearly demand. That's 1.5 million roughly yearly demand for new homes. So that means every single year the market wants 1.5 million homes roughly every year just to keep up with demand. Now we had a problem back here. See how we went way below the 1.5 million demand? This created a housing shortage. This housing shortage or deficit in new homes being built means that house prices are going to go very much higher. It's a lot higher. When house prices go higher, it's going to trigger home builders to build a lot more homes than the 1.5 million yearly demand. So we're going to go into what's called a real estate expansion phase. That's what this phase is here. That's what this phase is here. And you can tell, again, these green and red circles are these green and red circles. I overlaid them. So this is an expansion phase, and we're coming up to another expansion phase where this is the market conditions where it's ripe for commodities. That's why I'm showing you this. So we need to build a lot more homes, which means home prices are going to go higher, and I think we're going to get into an inflationary environment. This is one of the reasons. We also want to look at the commodity to gold ratio. And I didn't overlay the circles here, but whenever we go from a cheap, this is when gold is very expensive relative to oil, or oil is cheap up top. Gold is cheap down here and oil is expensive. If you look and overlay those circles on this chart, you'll see that we went from here to here during one of the booms. We went from here to here on one of the booms. And now we're way up here, the cheapest it's ever been. I think we're at like 40 right now. We're right here, and we're expecting this to come back down below 10. This is also another indication of if the commodity's cheap, and then if it's expensive, it would be down here. And that's another sell signal to us saying, yep, it's expensive, it's fully valued, we need to exit out of our positions. So it's the gold to whatever commodity it is ratio will get expensive. I also look at the mining costs. Whenever prices decline above the higher cost producers here, right now oil's at like 40, 45, somewhere in this range here, which means that all of these people are struggling. It's below the cost of production of oil, the high cost producers. So I always like to buy in this area so we have so we know that it's a bottom, because production and supply is going to be cut back, and eventually demand will come back, because this was a COVID issue. So the next one is the same thing. This is the average break-even oil price per shale oil. Eagle Ford oil, this is where SM Energy's at. It came back down. I said, they're not going to go bankrupt, but they are a low-cost producer in relationship to everyone else that's shale oil. And QEP, I think, is somewhere in this range as well. So both of those are on the low, kind of the low cost side, and I thought they were going to have a very good chance of not going bankrupt. And I thought that the oil price would come back pretty quick, so they would be just fine. But this is the stuff I look at making decisions like that. So the plan I mean, basically my plan is you buy in the green circles, the areas indicating undervaluation of commodities. And then you wait and sell when you hit the red circles at the top. And I'm referring to this chart here. You buy down here and you sell when the ratio gets expensive. It's around 8 when it gets expensive, around 1 when it's cheap. And right now we're really low. So that's the plan for the overall plan. That's our indicator of when to buy and sell, and having the confidence to hold when it's in between those two. Gold to whatever commodity ratio also flashes a red, which means that it flashes a sell signal when it becomes overvalued at the top of a commodity's boom. So that's another signal. Another signal is when home prices start to decline, or when housing starts to decline. That's another signal saying that we're entering a decline in real estate. And almost every time you have a decline in real estate, you have a recession because it's deflationary. This is when I sell and go to cash and wait for a crash. So cash to crash. And then eventually when you get your technical analysis, this channel does all this for you. You look at your technical analysis and you say, yep, these are cheap. That's when we're going to buy stocks perhaps. And then we look at stocks, if they're the ones that are underpriced in relationship to commodities, and then we go into them. That is the cycle there. So the conclusion is experiencing how to value assets using ratios just one time, I think will give you the confidence you need to use this system. It takes time to get the hang of it. It's not intuitive right off the bat. And with time, once you start using it, if you're looking at this channel and you start seeing things, it'll start making a lot more sense. Technical analysis does really help explain a lot of things. And I do that. That's why I go over these market updates. I'm trying to get you confident in using some of these charts, in seeing chart patterns, in seeing when I am purchasing things and how they react in the future. And I think a lot of people on the channel are figuring that out pretty quick. They're saying this guy buys when things are down and when things kind of contract to points, when the buyers equal the sellers is that contraction points. And then they see that, and then all of a sudden they see very large moves come next. They see 50, 200% gains, 50% gains come later, because what I'm doing is exactly what I'm saying in this presentation. I'm looking at the undervalued commodities or the undervalued assets. I look at the technical analysis of the charts, and then I marry those two together and say we are cheap, we have good market conditions, and I'm going to buy when this thing's bottoming out, and it's basically the buyers are equaling the sellers. And then it's just whenever the buyers come back in, when that money starts to rotate from one sector to another sector, it goes into the companies that I'm already in. So in my opinion, the most valuable thing here is knowing the valuation is the most important piece of this puzzle if I were to choose anything. Because really that tells you when to buy and when to sell using the ratios. So I hopefully the people who've been on this channel for some months now, they're really starting to figure this out very quickly, I think. I'm just putting the framework in front of you. And once you start figuring this out, it's literally feels like you're cheating. Because you know where to put your efforts and you figure out where to put your attention. Your attention's like, this is what's cheap. I'm going to focus my attention here. Once you focus your attention there, then you start looking at the charts, you start looking at companies, and you figure out what companies you want to go into and what charts look good. If you can marry all of this, if you can literally marry this all together, you're basically a professional investor at that point. Because you're extracting a lot of value out of all of your investments. Your timing is just, your timing is whenever that rotation of that money comes back into that sector. And you're really reducing your risk by using technical analysis, because then you get your timing that much more pinpoint. So this is very difficult to figure out by yourself. It took me a while to figure this all out. It took me some time to connect all the dots. And I did this all by myself. It was literally me figuring this all out and using it as a puzzle and figuring out this puzzle. Then I figured out technical analysis basically by myself. I took a couple, there was like a session or two that I watched someone else do it. I was like, oh, this is easy. I just started doing it myself, and then I just did a whole bunch, which basically ingrained it into my memory. So I had the motivation to learn all this. I mean, that was very important. And then after I figured all this out, the money started to come. And what you realize is that the most undervalued assets are the ones that you can gain the most on if they provide utility to society. So what I'm doing is I'm looking out 10, 20, 30 years, and you can see this in some of my videos. I'm looking far out there, and I'm saying, what are some of the materials that humans are going to be using in everything? And some of those materials, like silver and platinum, oil is going to be used, nickel, copper. I mean, basically, we're looking at the demand way out there, and we're looking at the market balance. The market balances of all these metals just show huge deficits way out there. When you have deficits, that means that prices are going to have to go up, and new supply is going to have to come online. And that's where all this ties into, if the price is below the cost of production, it's just a matter of time. I'm not going to say it's a 100% sure bet, because some of these we have to speculate in the producers. And sometimes the producers don't have good assets, and management's not good, and they screw it all up, and they're not efficient with capital. They can go bankrupt. There's a whole bunch of different things that can happen where the risk really goes up. But if you know where to look and you do your due diligence, I guarantee you'll have the ability to hold on, because you know the valuations, and you know that your timing is pretty close to being good. So if you like this content, please click the thumbs up button, subscribe. If you guys have any more questions, or if this isn't good enough for you to understand, leave some comments below. I can figure out how to present this so everyone understands it and has the confidence to hold through this next commodity bull market. Thanks for listening, and this is Finding Value.